Hey, good day, everyone. Bert Salazar here. Welcome to another webcast. I'm excited to be here with all of you today. More and more of you are signing in, so we're going to get started in about 2 minutes. And one of the main reasons why I'm so excited to be here with you today is we're going to be talking about my #1 subject matter in the world, which is how to legally divorce the IRS in retirement and how to do so legally without creating any issues and any concerns for yourself, your family, and your business. So, obviously I've been in the industry for almost 30 years, so I'll go into a little bit more detail on that as soon as we get started. But we're living exciting times. There's a lot of things that you can do in order to maximize the internal rate of return for you and your family when it comes to retirement distribution planning. So I'm excited to, dig deeper and go into some of the issues and concerns that I see whenever clients come in to see us for the first time, and after we conduct a thorough review of everything that they've done up until that point in time. So we should get started in another 30 seconds. We got more and more people coming in. What I do recommend is for the next few minutes, this is not going to be a very long webcast, but I do recommend that you turn off your cell phone, perhaps get yourself, a cup of water or coffee, and take some notes. Because at the end of the day, information without education always leads to failure. So I want to make certain that if you have any questions at the end of the webcast, that you can feel free to reach out at no cost or obligation to you in order to address your specific questions. So I guess, obviously, I don't want to make those of you that are already logged in wait any longer. So again, why don't we get started? Bert Salazar. I've been in the financial services industry for almost 30 years now, and in our firm we do 3 things. We do tax planning, we do insurance, and then we do alternative investments, and we use 3 different companies to do that. On the tax planning side of the house, we use Gable's Tax Planning Group, which is the logo that you see here, there in front of you. On the insurance side of the house, we use Cambridge Financial Partners LLC. And then under alternative investments, we use Camelot International Group LLC. And it's important to keep all 3 separate, because that way we can specialize as opposed to trying to be all things to all people. Now, today we're going to be talking about the tax-free or the tax-preferred financial bucket. And for those of you that follow us on Twitter, on Vimeo, on Facebook, we're always talking about the 3 financial buckets. You have your taxable bucket, your tax deferred bucket, and then your tax-free bucket or tax-preferred bucket, depending on how it is that you may want to call it. Whenever clients come in to see us and we do a complete audit of everything they've done up until that point in time, we realize that clients have a tendency to do a fairly decent job in their taxable bucket and their tax deferred bucket, but the tax-free bucket is almost non-existent, and that is the most important bucket under the IRS code, especially when it comes to retirement distribution planning. And just to give you a quick overview before we start digging deep into the tax-free bucket, your taxable bucket is primarily your checking accounts, your savings accounts, your CDs, your money markets, your traditional mutual funds, and so forth. Pretty much the money that goes into that bucket has already paid taxes. Every single year, depending on the growth of that bucket, on the interest that is being paid to that bucket, you will be receiving a 1099, which you will have to report for income tax purposes. Now, from a taxable standpoint, a taxable bucket is not a very good bucket to have, because everything is taxable every single year. On the other hand, is a very liquid bucket. So from a liquidity perspective, is a very, very good bucket to have in your arsenal of retirement distribution planning. By the same token, our recommendation to our clients is usually that you should not have more than 6 months of fixed expenses, perhaps sometimes a little bit more, depending if you want to have some business opportunities or investment opportunities that you can act quickly upon. But traditionally speaking, we're dealing with about 6 months of expenses in that bucket and that bucket only. And the reason why we want to limit the amounts of money that you should have in that bucket is, again, because of the tax liabilities that you would have along those lines. Now, the next bucket is one bucket that most of the clients and most Americans are fairly familiar with, and that's the tax deferred bucket. And the tax deferred bucket is primarily your IRAs, your 401ks, your 403bs, your pensions, all of those buckets, all of those investment vehicles will fit into the tax deferred bucket. Now, what makes the tax deferred bucket different than the taxable bucket is the fact that the money that is put into the tax deferred bucket is put in pre-taxed. The money grows tax deferred, but then when you pull the money out, you have to pay taxes on the whole thing. You have to pay taxes on the contributions, and also you have to pay taxes on the growth of that bucket. So the other concern that we have there is that everything coming out of that bucket is going to be fully taxable or fully reportable for tax purposes in retirement. So we also want to limit the amount of money that you should have in that bucket. Now, we have clients that come in and they have $1 million, $1.5 million, $2 million because they had 401ks or they own companies, and then they're rolling money into their IRAs, so they have large amounts of assets inside the tax deferred bucket, and that creates all sorts of different problems and taxation issues that many clients had never thought through prior to making those contributions. Normally, the most that we encourage clients to have in the tax deferred bucket is anywhere between $500,000 and $600,000, because anything above that, then you're going to have some major taxable issues and concerns that all of us are going to have to deal with at some point in time in the future. And then we have the tax-free bucket. Anything that does not go into the taxable bucket or the tax deferred bucket should go inherently into the tax-free bucket or the tax-preferred bucket, meaning that any overflow should go into that bucket. From a business perspective, the tax-free bucket should be the largest bucket of all three financial buckets that you have to deal with either now or in retirement. So now what I'd like to do is I want to dedicate the time for the remainder of this webinar in discussing the tax-free bucket. Now, there are only 4 vehicles that fit the investment principles of the tax-free bucket. You have your municipal bond funds, you have your Roth IRAs, you have your Roth 401ks, and you have your 7702 plans, which are your cash value life insurance plans. Now, out of the 4, only 3 are totally tax exempt. And those are the Roth IRAs, the Roth 401ks, and the 7702 plans. Remember that although municipal bond fund income is received federal income tax-free, it may have a negative impact on the provisional income calculations in order to determine what percentage of your Social Security benefits are going to be taxed in retirement. It doesn't matter how much income you generate out of your Roth IRAs, your Roth 401ks, and your 7702 plans. That income is totally exempt, not only from federal income taxation, but also from Social Security benefits, and most important, from any surcharge or any increases in your Medicare premium in retirement. So it is an extremely focused bucket, and I'm going to be discussing primarily the 7702 plans. I'm actually going to give you an example of the difference between a traditional retirement account, which you would find like a 401k in the tax deferred bucket, and the 7702 plan, and I'm going to give you an example. But just so you'll know, On the tax-free retirement bucket or the tax-free bucket, you know, the Roth IRAs has limitations. So obviously you can only put so much money there. In 2018, the limitation is $5,500. If you happen to be over the age of 50, you can do a catch-up contribution of an additional $1,000. The Roth 401k has a maximum contribution in 2018 for $18,500. Again, if you happen to be over the age of 50, then you can make an additional $6,000 of contribution in 2018 for a maximum of $24,500, and that doesn't include the match that you may get in a 401k from your employer. On the Roth, again, on the 7702 plan, the Roth IRA and the Roth 401k have limitations, but the 7702 plans have no limitations whatsoever. So if you're someone that has the ability to put away a lot of money for retirement, there's a very high probability that you're going to be using a very efficient 7702 plan to allow you to put in as much money as you possibly can in order to maximize the internal rate of return for yourself and your family when it comes to retirement distribution planning. So what I like to do at this point in time, and I want to start digging in deeper into the 7702 plan. Now, what are some of the features and benefits we need to consider when you are preparing to put together a 7702 plan? And remember, 7702 plans come in all different flavors. You could have, you could use variable universal life. You can use fixed index universal life. You can use whole life. You can use traditional universal life. Or you can use a straddle. You can use a combination of all, depending on the goals and objectives that you would wish to have for retirement when it comes to your family and your personal well-being. We at Cambridge are known to use straddles in order to increase the efficiency of these vehicles and these products when it comes to retirement. Not only that, we can set up several 7702 plans along the way. As long as we do it efficiently, then we're able to create layers of distributions between your Roth IRAs, your Roth 401ks, and different 7702 plans, and also to eliminate tax liabilities in retirement and enhance your internal rate of return. What I'm going to do right now is I am going to share my screen with all of you, and I'm going to walk you through a 7702 plan that we put together. This is an actual case. So again, I'm going to wear my reading glasses at this point in time because I need reading glasses now more than ever. And what I'd like to do is I want to share with you the pros and the cons of using an index universal life. And this is one example, but we could use whole life, we could use any other type of product. And we're going to compare that to a tax deductible retirement plan. Now, in this example, we're going to be discussing, I'm going to go through some of these pages that we don't need because I want to bring you to the ones that are going to be critically important for all of you. So again, we're going to be discussing the difference in making contributions to a traditional retirement plan, the efficiency and the effectiveness of those contributions, and then we're going to be comparing them to making those contributions into a 7702 plan for business purposes. So you're going to see there the payments as you see in your screen on both sides of the ledger. The left-hand side would be the contributions to your traditional retirement plan, and then on the right-hand side of the ledger would be the contributions to your 7702 plan. Let me take you directly now, and this will break down the contributions and the distributions and so forth, but let me walk you down and take you directly down to the ledger, which I think will give you the ability to truly understand the difference between the two plans. Now, On the Roth, my apologies, on the traditional retirement side of the house, in this case, we're using a traditional retirement account. We're going to use a yield or an internal rate of return of an annual rate of return of 8%. On the 7702 plan, we're going to use a little bit lower rate of return. In this case, I'm going to be using a 7.06. So there's an arbitrage between the two, but it won't matter at the very end, as you will see. Obviously, this client happens to be in the 25% marginal tax bracket, and I'm going to start walking you through the ledger so you can see the difference between contributions on one side versus contribution on the other side. Now, as you can see there at the very top, you will notice that this is a 45-year-old male wishing to retire at the age of 65. So he's going to be making contributions to his retirement plan and then making a comparison of the same contributions to a 7702 plan, and we're going to walk it along those lines. So notice that in column 1, we have a contribution, tax deductible deposits to the IRA. In this case, it's not going to be an IRA, it's going to be a qualified plan because we can put more money. This client can fund it at this point in time with $16,000 every single year, and he's going to be doing that until age 65. So the last year of contribution in this plan will be the age of 65. Now, column number 2 gives you the after-tax equivalent of a contribution, an IRA deposit, or a tax-deductible account deposit, in this case a 401k, which would be $12,000. Because if you're making contributions to a 7702 plan, which is contributions to the tax-free bucket, the contributions into a tax-free bucket are after-tax contributions. The money does grow tax deferred, but then when you pull the money out, it's tax free. So in order to make an equitable contribution, we needed to pay the taxes on the contributions to the 7702 plan, where in the traditional 401k plan, we didn't have to pay taxes on the contribution. So the difference between the two is $12,000. So that means that $12,000 is going to go toward the 7702 plan, and $16,000 will go toward the tax deductible retirement plan. Now, what are some of the issues and concerns? Now, if you go all the way to column 11, you see that 7702 plans have an immediate death benefit assigned to them because it is a cash value life insurance policy. So therefore, there's an immediate death benefit. I would argue that if you're going to use a 7702 plan as a supplemental retirement plan, I would argue that it would be a self-completing 7702 plan because let's say that the client dies in the first year of making the contribution to the traditional retirement account or the 7702 plan. Well, in the traditional retirement account, the client is going to have, as you can see there, in column number 4, $16,979 at time of death, and then that money will go to the survivors. In the 7702 plan, the death benefit would be $598,912. So obviously, there's an enormous difference. So if the client were to die prior to retirement, there's a very high probability that the 7702 plan is going to perform on the death benefit side of the house a lot more efficiently than a traditional retirement account along those lines, okay? But let's go ahead and fast forward. So again, we're making, as you can see in line 7, column 7, we're making $12,000 of contributions to the 7702 plan, as opposed to $16,000 in contribution in column 1 to a traditional retirement account. Now, when you get to age 65, notice that in column 4, in the tax deductible retirement plan at the age of 65, you have $778,749 worth of assets in that plan. And then on the 7702 plan under column 9, you have $474,631. So right there, you would think that obviously the tax deductible retirement plan outperformed the 7702 plan because one has north of 778,000 and the other one only has 474,000 and change. But remember, the 7702 plan has already paid the taxes. The tax deductible retirement plan has not paid any taxes whatsoever. So now Uncle Sam is a partner to you under the tax deductible retirement plan scenario. All right, so now both, now this client is 65 years of age. So now we want to start making a comparison as to the distribution rate and the efficiency of the distribution rate from a retirement perspective. Remember that when you get to retirement age, the rules of engagement totally change. Now you're going from an accumulation rate to a distribution rate, and this is what we're going to be digging in at this point in time in this webinar. Notice that at age 66, this client is starting to pull out $50,928 out of the tax deductible account. Now, obviously, that would be a net after taxes. So based on this client's tax bucket or tax bracket, in order for him to generate $50,928 of income in retirement, he would have to pull out just north of $72,000 out of his tax deductible account, pay taxes on that distribution, and then net out $50,928. Now, if you go to, in this case, would be column number 8, notice that under the 7702 plan, the client is pulling out $50,928, which is the same amount. But in this case, because it is a tax-free distribution, the client is only invading $50,928 per year out of that account, as opposed to $72,000 and change. And that's without taxes going up in the future because of the fact that under the tax deductible retirement account, the taxes need to be paid at time of distribution. So fast forward, the client is taking out the $50,928 out of both sides of the ledger. And then now we're getting into their mid 80s and their late 70s and mid 80s. And notice that in the column 3, which is the after-tax withdrawal from the tax deductible retirement account, at the age of 86, this client ran out of money. Actually, at age 87, the only thing that this client has in his account is $6,350, which he will then withdraw, and now he has no money whatsoever. Now remember, I always say that, you know, the fatal 4 is the risk of dying too soon, the risk of living too long, the risk of living with a disability, and then the risk of living with eroding factors like taxes, inflation, stock market volatility, interest rate volatility, and the like. In this situation, this client lived too long. In other words, you know, if getting old is bad, getting old and running out of money is even worse. And the main reason why this client ran out of money is because of the tax liability and the tax inefficiency out of the tax deductible drawer at time of retirement. Notice if you go to column 8, which is the distribution out of the 7702 plan, notice that this client in this example can continue to take that $50,928 out of this account for the rest of his life. Notice how when we get to age 119, the client still has the ability to pull out $50,928. See, the challenge that we have with many of our clients is the fact that for many years, they have only been thinking about the accumulation rate and not about the distribution rate. And as you will see, and I'll go into a couple more details in this exercise, as you will see, the distribution rate is more important in retirement than the accumulation rate, because you notice that at age 65 there was more money in the tax deductible retirement account than in the tax-free account. But the reason for that was that the tax deductible account had not paid taxes. Now, that is based on today's environment of taxation that we're living in. Now remember, for the next 8 years under the new tax law, we're actually living at a fairly low tax rate. So the ability for you to do tax planning with your assets between now and the 8 years is going to be very critical if you want to achieve a 0% tax bracket in retirement. Just think of it this way: where do you think that taxes are going to be in the next 10, 15, 20, 25, 30 years? Are they going to be lower than they are today? Are they going to be at the same level than they are today? Or are they going to be higher than they are today? Now, when you take a look at the national debt, which is exceeding $21 trillion today, when you factor in the unfunded liabilities for Social Security, Medicare, Medicare Part D, Medicaid, and the interest on the national debt, there's a very, very high probability that taxes are going to have to double, or this country is going to go bankrupt in the next 30 years. Now, where are you going to be 30 years from now? Because you have to be able to plan for at least 3 decades of retirement. Are you going to be left holding the bag? The other thing that many clients don't consider is that as you get to retirement, many of the deductions and exemptions and credits that you had under the IRS code will actually go away. Because obviously, if your mortgage is paid for, then you can no longer take that mortgage interest deduction. If your kids are hopefully going to be out of the house by that time, you can take their exemptions and credits and so forth. And many times, if you're someone that enjoys making charitable contributions to the charities of your choice, normally when clients and Americans reach retirement, they start shifting from making those charitable contributions to giving more of their time, and obviously the time is not deductible. So now you're no longer making those charitable contributions, or if you are, you're not making them to the level that you were making them before, so you have less and less tax deductions to deal with. So these are things that when you start thinking about retirement distribution planning, many Americans are not really thinking through. The other major issue that a tax-deductible retirement account will provide for you is that $50,928 that you're pulling out of those accounts, remember, after the age of 70 and a half, the IRS is going to force you under the required minimum distribution rules to start taking money out of those accounts, whether you want to or not. And the more money that you have in those accounts, the higher the mandatory distribution rate and the higher the taxes. And by the way, under provisional income calculations, that distribution from your traditional retirement account it may very well force taxation not only of that distribution, but taxation of your Social Security benefits to as high as 50% or 85% of the benefits coming out to you from Social Security and the income that you're generating from that account. It may accelerate the taxation of your capital gains. It may actually increase the Medicare premium that you would have to pay annually for yourself and your family. So you have to be very careful how you manage the tax deductible retirement side of the ledger, where on the tax-free bucket, as you will see here with the 7702 plans, whether the income is coming out of a Roth IRA, a Roth 401k, or this example of a 7702 plan, you're not going to have to worry about having any negative impact on your Medicare premium excess, or your Social Security benefits, or your capital gains. So you're able to have a more efficient distribution plan than you would have had otherwise from a business perspective. Also, please bear in mind that when it comes to the fatal four, which I just mentioned a few minutes ago, the risk of dying too soon, living too long, living with a disability, and living with eroding factors, the 7702 plan is the only plan under the IRS code that has the ability to fit in each of those four fatal issues and concerns, and it allows you to create a buffer and a layer of protection that will protect your family and yourself from the risk of living too long, the risk of living with a disability, the risk of living with eroding factors like taxes, inflations, and market volatility, and so forth, and last but not least, the risk of dying too soon. So when you really look at a 7702 plan from an efficiency standpoint, you will notice that if you work with a retirement strategist that has the ability, because there are many different ways that you can muster a 7702 plan, but you can do so in different layers and different ways. You can set up a 7702 plan that would be exclusively set up for retirement distribution purposes. You may have a 7702 plan that will also have riders there that will protect you against the risk of living with a disability, long-term care, and so forth, that you would not have otherwise unless you buy a straight long-term care policy. And there's some issues and concerns with those types of contracts as well. But you also have the ability to set up a 7702 plan in order to create asset protection in retirement for you and your family. So the flexibility and the ability to set up in different ways of a 7702 plan is one that needs to be addressed. And the sooner that you can get to address these plans, the better off you're going to be. Again, when it comes to retirement distribution planning, just because you may have more money at retirement, let's say at age 65, in your tax deductible retirement plan compared to the tax-free bucket, the efficiency distribution rate is totally the opposite. You're more efficient in the distribution of your tax-free bucket than you would ever be in the tax deductible bucket from a business perspective. Let me go ahead and stop sharing my screen at this point. And again, kind of share with you that for every client, the type of planning that we do is totally different because every client is different from a business perspective. The other thing that you need to pay attention to when you're putting together a 7702 tax-free bucket straddle is to identify, the distribution rate. The vast majority of the clients that I deal with are looking for a number of things that they never thought through prior to getting to retirement. They're looking now for tax-free income. They're looking for guaranteed income. And most important, they're looking for tax efficiency and their ability to spend down all of their assets in retirement, and also in order to increase the efficiency of their lifestyle in retirement, and doing in such a way that they're not going to create any issues and concerns to the surviving spouse or surviving family members, which is something very, very critical that the vast majority of the clients that we engage on an ongoing basis feel very strongly about. Many a times, because of lack of proper planning, many of our clients that we have engaged, we have not been able to help. And the reason why we haven't been able to help them is because they came to see us way too far and way too long in the game of retirement, because they were already in their late 70s, early 80s, and they were now seeing that they were running out of money. They were now seeing that inflation was catching up to them. So now they needed to start invading principal, because up until that point in time, they were just taking interest and not touching the principal. But now they found themselves in a position where now they needed to take a higher distribution in order to maintain their standard of living. And by invading principal, now that principal was going to be lower and lower every year. And because of the fact that the principal was going to be lower and lower every year, now the interest generated would be lower as well. So it was compounding the distribution effect. And many a times, the major issue for these clients and these individuals that we attempted to visit with and helped was, Bert, am I going to disinherit my family, especially my surviving spouse, in retirement? So if you use a proper 7702 plan, then you have the ability to do so. One final thought, and then I'll leave you with this. 7702 plans can be used very efficiently to offset the loss of a Social Security benefit at time of the first death. You see a husband and wife in retirement taking Social Security benefits. When one of them passes away, the surviving spouse will either keep their own Social Security benefit or assume their decedent spouse Social Security benefit if that benefit was higher than their own. So that's a good thing. The bad thing about that is that if you haven't done Social Security distribution planning and you haven't done any Social Security replacement planning, one of those incomes is going to go away at the first death. So therefore, when you have family members and a husband and wife in retirement enjoying two Social Security benefits and one of them goes away, it does pose all kinds of issues and concerns, because now that income is no longer coming in because there's only one remaining Social Security benefit, and that surviving spouse may be forced to accelerate the distribution rate of some of the other accounts that they have in order to offset that Social Security benefit that, if done properly, would have come out tax-free, but now it cannot, because now you may have to take more money out of your tax-deductible account in order to offset that deficit. So again, thank you so very much. Obviously, you're welcome to follow us on YouTube, on Vimeo, on our Facebook page. If you do want to have a conversation with me, and this is entirely up to you, at no cost or obligation, then I encourage you to reach out to me. You can call me at area code 786-766-1042. You can reach out to me at Bert, B-E-R-T, .Salazar, S-A-L-A-Z-A-R, at Cambridge, F as in Frank, P as in Paul, LLC.com, or you can reach out to me at Bert, again, B-E-R-T, at BertSalazar.com, and I'll be more than happy to answer any questions that you have. Obviously, we continue to do these webinars and webcasts and videos that we put out on a weekly basis, because we're true believers that information without education always leads to failure. Our motto in our firms is very simple. We want to change the financial world one client at a time. And last, I'll leave you with this thought, which I think is something that you have been able to see today based on this webinar that we have done and this webcast, is that our number one goal with all of you on this call is to kind of help you change the way that you see things. Because when you change the way that you see things, the things that you see change. So again, thank you so much for giving me a few minutes of your time, and we'll talk to you again soon. Take care. Bye.